Ever wondered what the difference is between mutual funds, index funds, and ETFs? Let's start by understanding what mutual funds are. Mutual funds present a bundle of benefits. The first one is convenience. When you invest in a mutual fund, you're essentially buying a package deal of various stocks. It's like getting a sampler platter at a restaurant. You get to taste a bit of everything. This instant ownership of a broad range of stocks is what makes mutual funds so appealing. The second advantage is diversification. Picture this: rather than putting all your eggs in one basket, you're spreading them out. This way, if one egg cracks, it's not a total disaster because you have many others safe and sound. This spreading out of your investments across different stocks, also known as diversification, is a defensive strategy that reduces your investing risk. The third major benefit is professional management. Mutual funds are managed by industry professionals who pick the stocks for you. It's like having a personal stylist who knows what outfits will look good on you. But remember, this stylist isn't working for free. Mutual funds can charge hefty yearly fees, which over the long term can add up to a significant amount. While mutual funds offer a lot of perks, these high fees can be a downside. This concern over fees sparked the creation of something new in the investment world: the index fund. Next up, we have the index fund, a revolution in the investment world. The beauty of index funds lies in their simplicity. They're passively managed, meaning they follow a predetermined formula, typically mimicking renowned stock indices like the S&P 500. This strategy is not about beating the market, but rather about going with the flow, and that's the magic of it. Think about it. You're investing in a broad market index, reaping the benefits of that entire market's performance. And because there's no need for financial wizards to constantly monitor and adjust the fund's portfolio, the fees are drastically reduced. In fact, they're so small, they're almost insignificant. But that's not all. Index funds also give you the power to automate your investment. No need to constantly watch the market or make frequent decisions. Set up a monthly deposit from your checking account, and voila, you're buying more shares without lifting a finger. So, in essence, index funds offer a low-cost, hands-off approach to investing. You're not trying to outsmart the market. Instead, you're riding the wave of the market's overall performance. But what if you want more control? What if you want the ability to buy and sell whenever the stock market is open? Well, that's where another player enters the scene. Enter ETFs. Lastly, we'll dive into ETFs, or exchange-traded funds. Emerging on the scene after index funds, ETFs brought with them a unique advantage. They gave investors the freedom to buy and sell shares whenever the stock market is open. Unlike index funds, where you can only buy and sell once a day, ETFs offer you the flexibility to trade throughout the day, giving you more control over your investments. But like all good things, this advantage comes with a catch. Every time you trade ETFs, you have to pay trading commissions. While these might seem insignificant initially, they can add up over time and eat into your profits. There's another, less tangible downside to ETFs. This constant ability to trade can lead to impulsive trading. There's a temptation to constantly buy low and sell high, to try and time the market perfectly. However, this is a dangerous game. More often than not, it results in losses rather than profits. It's crucial to remember that investing is not about short-term gains. It's a long-term game. You're not trying to make a quick buck. You're building a nest egg, a secure financial future. ETFs offer tradability, but it's important to avoid impulsive trading. Remember, investing is a long-term game, so whether you choose mutual funds, index funds, or ETFs, make sure you're in it for the long haul. To summarize, each type of fund has its own benefits and downsides. Mutual funds offer convenience and diversification but come with higher fees. Index funds, on the other hand, follow a long-term strategy with lower fees. Lastly, ETFs provide flexibility to buy or sell shares whenever the market is open, but may encourage impulsive trading. Do your research before you invest, and remember that you are always best served by yourself than by others. Make sure you subscribe and hit that bell for notifications of future uploads.